Hello, everyone. It is Thursday. Typically, we do these on Wednesday. But today we are doing one on Thursday simply because we were out and about traveling and we were all scattered to the wind. Welcome to Financial Awareness Basics webinar. My name is Tom Bailey, and I'm an outreach manager here with ECMC. And today I'm joined by my partner, Bridget Ellis. We're glad to have her on the call this morning. April's on vacation. Normally I co-present with April, but she is somewhere. Where in the world is April Hunt? Kind of like, kind of like that, what they used to do on NBC on the Today Show. Anyway, I digress. So Bridget and I are both AFCPE accredited financial counselors. We're very proud of that distinction, and we really spend a lot of time studying and taking the test. We both, as I said, we're both accredited, and gives our work some credibility, I believe. I think because AFCPE, the organization, is the gold standard in financial wellness and financial literacy and financial education, that lends credibility to our work. So we're really excited about that. So as I mentioned, we're both outreach managers with ECMC. And I'm kind of rambling, aren't I, Bridget? Yeah, I have to give you all a little bit of a disclaimer. I was traveling yesterday from Sacramento to Palm Springs, where I live here, and it should have taken me 4 hours, and because of a missed connection in San Francisco, it took me almost 17 hours to get home yesterday. So I'm operating on very little sleep today, but we'll go ahead and get started here. So if I don't sound like myself, I apologize. Today we're going to talk about credit reports and scores. It's a very important topic. A lot of the students that we work with have, they've heard of their credit report or their credit score, but they may not know too much about this information. And so, as usual, this is a webinar that's a train the trainer type session, whereas you can turn around and use this information to use with your students and maybe learn something yourself that you can use in your own life. But first, I'm going to turn it over to Bridget, and she's going to help you figure out how to communicate with us during the session.
Thank you, Tom, and I'm with you. I'm already to Friday as well. I think that's what happens when we get to Thursday. We're already thinking about Friday, and I know you are if you're sort of jet lagged, if you will, from travel. So again, welcome everyone. I'm Bridget Ellis. You can see this map. You see that Tom is as far to the west as he can be in California, and I'm as far to the east in North Carolina as I can be. So what we want to see is during our session today, the way that you can communicate with us is through our chat feature. So we want to have everyone, if you will, put in our chat, click on the chat, put in where you're from. We kind of like to see where everyone is calling in from. Hi, Tanya, you're close to me in Henderson. Okay. Pennsylvania, Sacramento, Denver,
I just left Sacramento yesterday.
Okay. So we've got lots of representation. Michigan, California again. One of the things I want you all to know too is once we are finished with the webinar, there'll be a recording of the webinar sent to you, the link to the recording, as well as a PDF of the presentation. And if any of you need a certificate, Tom, am I correct that they would just need to email you or I to actually get that if they need a certificate of attendance? Is that correct?
That is correct. Our contact information will be on the last slide. And so if you need a certificate, just let us know and we'll send you one out right away.
Great. So again, welcome everyone. Look forward to talking to you today, and I'll turn it back to you, Tom.
Thanks, Bridget. So what are we going to talk about today? We already know that we're going to discuss credit reports and scores, but we're going to dive a little bit deeper. So what is a consumer credit report? We'll take a look at that and what all is contained in that credit report. We'll take a look at credit scores and how they're calculated, how they're used, the benefits of good credit, some of the myths surrounding credit reports and scores. If any of you work, well, all of you probably work on a college campus, and I have, and Bridget has, and we've had this conversation so many times with students that come into our offices and say, well, I have a friend who told me this, and you already know where this is going, right? So there's some incorrect information floating around about credit reports and credit scores, similar to, misinformation about financial aid and other things. So we'll clear that up, or try to clear that up. And at the end today, we'll give you some additional resources if you want more information on this topic. So these are some of the resources that we use to develop this webinar today.
Great. So we're going to get started with the credit cycle. And I like this illustration because it gives that circular motion, if you will, on the process of what happens related to your credit. So it starts with you. So you're paying the lender, or whoever you owe money to, because that can impact. So sometimes it's not just a loan lender, but it's maybe a credit card or maybe some other place that you owe that can impact your credit. And then the lender updates their records. And then the lender, of course, shares this history with the consumer credit reporting companies, and then the consumer credit reporting companies share with new lenders. So that's how the score actually gets to helps to get out there, so that then when you are someone else is pulling your credit for a line of credit, they can see maybe what your credit score is based on your behavior. So keep in mind, it's the behavior. It's reporting, similar to, I guess, those of us who come from a financial aid background, the update to NSLDS or the clearinghouse as that information flows through that. So again, make sure that our students can know exactly how this happens. Sometimes I don't think they grasp the fact that their behavior related to their finances can matter down the road. Tom? Tom, I can't hear you. Are you there?
I am so sorry. I put myself on mute to clear my throat, and I forgot to take it off, but I was talking nonetheless. Now we're going to turn our attention to the credit report. Now think of your credit report as a history of your ability to manage credit. And I like to compare it to, say, a college transcript. So just as your academic transcript shows your grades, your credit report is really going to show your credit grade, if you will. And lenders who you borrow money from are going to report things like your payment history, the amount you borrowed, how much your credit limit is, your outstanding balance. That's really important. That's key into also the calculation of your credit score, which we'll get into in a few minutes. It really is going to take a look at your payment history, good and bad. Now, your good payment behavior is going to help you, but your bad payment behavior is going to cause you some problems. And then also on your credit reports, there's going to be a section that shows inquiries. Now, inquiries are handled a little bit differently, and we'll talk about those, but there's a couple different types of inquiries, but those are listed on there. And lenders report to this every 30 days. So it's really important to know that. It's one of those things where, it's very, your credit report's very current, just like your NSLDS data. Ooh, I couldn't get that out.
Lots of acronyms, right?
Right. Let's move this. There we go.
Next, we're going to talk about the 5 zones in this credit report. And so the first one, personal information. That's that identifying information like your name, your address, social security number, date of birth, employment information, those things that identify you. And these actually are factors that are not used in the credit scoring, but it's information that you are supplying to those lenders. Then you have the public records, such as the bankruptcies and unpaid taxes, judgments, child support, those kinds of things. These credit agencies also collect on this information from state and county courts, any kind of overdue debt, like we said, any kind of public information, foreclosures, any of that would be on that. And then next you would have the trade lines. These are, trade line information is literally detailed information on loan payments, your credit limit, your high balance, payment history, all of those things. So it's these are your credit accounts, those accounts that show up. These lenders will report on each of these accounts that you've established, and they'll report the kind of account that it is, whether it's a bank card or auto loan or a mortgage, those kinds of things. They'll even have the date you open the account, what your limit is on the loan or the loan amount, and then they'll have the account account balance and any kind of payment history that's there. And then lastly, you have the inquiries. So you have, when you apply for a loan, you authorize that lender to ask for a copy of your credit report. That's an inquiry. This is how the inquiries appear on the credit report, because they see these. The inquiry section, it contains a list of everyone who accessed your credit report within the last 2 years. So the report, you will see list of both voluntary inquiries, that's spurred by your own request for credit, and involuntary inquiries, such as when lenders order your report so as to make you a pre-approved credit in the mail. So keep that in mind. These inquiries actually show up on that credit report.
And there we go. I couldn't get the screen to move. Now, it's really important. I know I keep saying it's really important, but it really is to know how long information stays on your credit report. As you can see, different items appear on your credit report. They have different lifespans, and mistakes that we have made, can stay on our credit reports for a very, very long time. Also, good behavior stays on there for a very long time. So things like tax liens and bankruptcies, Chapter 7 bankruptcies, those have the longest lifespan of around or at 10 years. So those are things that are going to affect your ability to get credit. It's going to lower your credit score and that sort of thing. Things like accounts in good standing are going to stay on there indefinitely. Closed accounts in good standing, 10 years, that's a good thing. But let's look at something like late or missed payments. So let's say you go out this month and you're just going crazy on the credit card and you're spending a lot of money, and then the bill comes next month and, oh gosh, I don't have enough to make the minimum payment. I'll just put it off until next month when things are a little bit better. So that one mistake or that one little indiscretion there is going to stay on your credit report for up to 7 years. So that's a long time for a little bit of an indiscretion, if you will. So your credit score will be impacted immediately, and then probably the first couple of years it will have a more significant impact. But as time goes on and you exhibit better payment behavior, the severity lessens. But I digress. Let's take a look at things like Chapter 13. Now, Chapter 13 bankruptcy, that's just a reorganization. And so in that instance, it's going to take 7 years, whereas a Chapter 7, which is a total liquidation, my goodness, that's going to last about 10 years as well. So the shortest lifespan are credit inquiries, and Bridget mentioned the voluntary and involuntary, and sometimes you may hear a soft inquiry, whereas maybe you pulled your credit just to check it, or somebody who was trolling your credit report to send you offers. Those don't count against you actually, but they do stay on your credit report for up to 2 years. So you can see the lifespan of the different types of behaviors.
Absolutely. And as Tom mentioned before, this is all very important. And I think sometimes many people don't recognize the importance of how long something can stay with you, good or bad, if related to your credit. One of the things that we need to make sure we hone in on is that to have students check their consumer credit report. They need to be in control of this. They need to be looking at it, because there have been times when there's been errors on one of the 3 credit reports. As a matter of fact, there was a study that was done that 1 in 5 consumers had an error on at least one of their 3 credit reports. So annually, you need to check name, address, birth date, social security number, accuracy of the accounts. All of these things need to be looked at. And I don't know that in this day and time we live in now that I would want to check it more often than that, simply because especially if they see something, if they were to see something that looks odd, or if you move and that kind of thing, you want to be sure that you're checking that information. There was also a study, and I think these statistics are very, very interesting, that where participants were encouraged to use the Fair Credit Reporting Act process to resolve any potential credit report errors. So there's a process there, but what they found was, and this is interesting, so I'm going to read this to you just because I want you to hear this. 1 in 4 consumers identified errors on their credit reports that might affect their credit scores. 1 in 5 consumers had an error that was corrected by a credit report agency after it was disputed, on at least one of their 3 credit reports. Also, then there is 4 out of 5 consumers who filed disputes actually experienced some modification to their credit report. Slightly more than 1 in 10 consumers saw a change. And this is, I think, very, very interesting. 1 in 10 saw a change in their credit score after the modified errors on their credit report. And then approximately 1 in 20 consumers had a maximum score change of more than 25 points. And then 1 in 250 had a maximum score change of more than 100 points. Now, you say 1 in 250, suppose you're that one, that's 100 points. So all the more reason that you need to verify the accuracy of these accounts. Are the accounts, the ones that are on there, are the ones that you opened? Make sure someone else didn't open those in this world of identity theft. Are the balances correct? You thought you paid it off and they're still showing a balance. Are the accounts showing late payments when you really paid on time and you have that documentation? Make sure you're looking at that. And if you have, something that you think is a discrepancy, contact the creditor as soon as possible when you notice that mistake. It could just be a data entry error or something like that that could be impacting your credit. So again, check your consumer credit report. You need to be in control, and it is very important that you're in control of that.
And to go along with that, Experian, Equifax, TransUnion, the National Consumer Credit Reporting Agencies, they're required to provide each consumer, upon request, a free copy of their credit report once every 12 months. And you can also go to annualcreditreport.com to get a copy of that credit report as well. That is authorized by the federal government. That organization is authorized by the federal government to provide you with a copy of your free credit report. Now, we suggest, because you can get one from each credit bureau, we suggest not getting them all at once and staggering them out, maybe one a quarter. That way you have the ability to check them more frequently, because if you're checking them all at once, then you may miss some potential errors later on in the year. So stagger those out to make it to work in your favor, so that you can keep an eye on it. I myself, I have credit monitoring. I signed up for it years ago through Experian. I have it on my phone. It cost me $9.95 a month or something like that. It's relatively inexpensive, or I think so. And I get alerts not all the time, but regularly. Your score has changed, or we noticed you're using your credit card more. We travel a lot in our jobs, and we use our personal credit cards to obviously get reimbursed, but there are times that, when my account cycles, it reports to the credit bureau, so it looks like I'm using more credit. So things like that. So it's critical to keep an eye on your credit report. The students that we work with are among the highest percentage of the population who become victims of identity theft. And checking your credit report is a great way to spot, or potentially spot, that you become a victim of identity theft. So our students need to be aware and be checking. I know that they have a lot of other things going on. They're going to school. They might be working and going to school. They may have a family as well. Lots of things going on, but it really has become easier. One thing I really like is that my credit cards offer credit monitoring as well. So I get I see my credit score. If it goes, if it swings dramatically in one direction or another from month to month, I know that there's probably something I need to take a look at.
Absolutely. And as we relate this to students, sometimes they don't even know what a credit score is, depending on where they're coming from, and they don't even realize they need to be ahead of this and checking things. So, we want to make sure we encourage them to look at that, as well as we need to educate them. What is a credit score? So what is a credit score? It's actually used by the lenders to predict behavior. So you kind of think of it as a test score. The higher the score, the better your grade. The more negative marks on your credit, the more points taken off your score. Makes sense, right? So once a creditor has that score, then they are able to assign a letter grade. Again, it sounds like school. This is something that students maybe can relate to and understand. The letter grade translates directly into the rate and the term you'll receive on a loan you apply for. So the higher the grade, the better terms you may have on any kind of credit that you're trying to establish, any kind of loan. And it also estimates the likelihood that you'll pay back those future loans. So you're at a better risk for a creditor if you have an A grade, which would be the most credit-worthy borrower. A and B are considered good borrowers. So banks, like to lend only to the top, which is the A and Bs, right? Those with the less than perfect credit are lumped into a subprime category, which is the highest risk borrower. And, just like in high school, your grades can limit your choices of college. This can limit your terms on credit, whether that be a loan, or even prevent you in some cases from receiving a loan, depending on what that is. Again, I think it's something that students need to know ahead of time before they jump into as we call it, the real world, and have all of this impacting them before they even realize. They need to be on top of that. Let me ask you, and right here you can see your score at www.myfico.com. One question for everyone. When you see a car advertisement that says 0 down and 0% interest, who do you really think is going to qualify for that? Type in the chat. 0 down, 0% interest. Because they're going to have people who, they're going to look to see who actually qualifies. We know that's a marketing tool. What would you guys say? A scores, absolutely. A, someone with good credit score, grade A. A only, absolutely, absolutely. And I think, again, this is the message we want to get to our students, that they understand, maybe in the simplest of terms, A, B, C. You need an A, you need a B, at the very least a B, but you want to make sure that you're in that category to have that higher score. Tom?
Thanks, Bridget. And that's an important distinction. That is called, when you go into the dealership and you roll out the door that day with a brand new car, that's called spot financing, and only those A people can get it with 0 down and very low interest rates. And I did that once. That was before the market crashed in 2008 and everything seized up, and boy, you don't see much of that anymore, but they are out there, but it's only for the best borrowers. Now we have a video that we're going to share with you, and I borrowed this from wallstreetinvestor.com, and it's a great illustration, and it has two different individuals and with two different credit scores, and it's going to show you the impact it has on borrowing. So we'll take about 3 minutes to take a look at this video.
Understanding Your Credit Score, presented by wallstreetsurvivor.com. A credit score is a simple 3-digit number that tells lenders how likely you are to repay a loan. Here are two friends, Leslie and Andy. Leslie and Andy are both 30 years old, living in the same city, working at the same place, and earning the same salary. Leslie is fiscally responsible. She puts a portion of her salary into a savings account every month.
Oops, something happened. Did it just cut off? Can you all hear me?
Always pays her credit card bills on time and has never missed a payment on the mortgage of her home or her student loans. Andy, on the other hand, is a fiscal mess. Andy lives beyond his means and is always pushing the limit on his credit card and isn't afraid to miss a payment or two to buy the things he wants. Andy rents an apartment and hasn't even paid off his student loan yet. Now, if both Leslie and Andy came to a banker looking for a loan, which one do you think will get the better rate? Obviously, given their histories, Leslie is more likely to pay back the money she borrows on credit on time. On the surface, however, Leslie and Andy look pretty similar. Same income, same job, same city. It's only when you dig a little deeper you can get to the good stuff. In order to save time, lenders invented the credit score that takes into account all of your financial history. Banks use your credit score when you apply for any loan, such as a mortgage, a business loan, a line of credit, or car and student loans. Scores typically range from 200 to 850. The higher your score, the better your credit is and the better rates you'll get. The average score in the United States is around 711. A score of around 740 and above usually gives you the best interest rates, and scores of 620 and below usually prohibit you from borrowing any money at all. A good credit score is important to get good rates on the money that you borrow. For example, given their spending habits, Leslie's credit score would be closer to 850, while Andy's would be closer to 600. If they both need to borrow $1,000, Leslie's interest rate would be closer to 5%, while Andy's could be as high as 20%. So, while Leslie's monthly interest payments would be $50, Andy's would be $200. You can build good credit by getting a credit card as young as possible, paying off your credit card in full every month, sticking with the same credit card for a long time, and never missing a payment on a loan. To learn more about credit reports and other personal finance topics, head over to wallstreetsurvivor.com.
I really like this video. There's only one thing I do disagree with, and that is getting a credit card as young as possible. You know, I agree that, you know, if you do get a credit card, managing it well will help you, but you can. I just don't like that, getting a credit card as young as possible, because I think that sends the wrong message there. Anyway, I digress. Another aspect of this video that I liked is it's just a very good illustration between Leslie and Andy. And I don't know if anybody on the call recognizes that these are characters from a television show, Parks and Recreation. So, but you can see just the slight difference in credit score, how much of a difference that made in the overall interest that was charged and how much was paid back. We did have a question, will this presentation be shared? And yes, we will be sending out a copy of this presentation sometime this afternoon once Zoom has processed everything.
Great, and you're exactly right. So I love that video as well. It kind of breaks it down to show, you know, what's really happening. So now let's talk about and educate ourselves on how is the score calculated. So, you know, your FICO score, it considers both positive and negative information on the credit report. Late payments lower your score. Establishing or reestablishing good track record of making payments will help raise your score. But understand that these percentages are based, you know, on the importance of the 5 categories for general population. Your FICO score is only looks at the information on your credit report. So, you know, it could vary some. So we want to look at these different categories. Payment history, that makes sense. First thing any lender wants to know is whether you've paid past credit accounts on time. It's one of the most important factors in that FICO score. So keep that in mind. That's at 35%. And then you have amounts that you owe. The actual amount makes a difference. Having credit amounts and owing money on them does not necessarily mean you're a high-risk borrower with a low FICO score. You may have, it depends on the amounts that are there. Also, the length of the credit history at 15%. In general, longer credit history will increase your FICO scores. However, even people who haven't been using credit a long time may have high scores, depending on how the rest of the credit report looks, what they've paid back, all of these other categories. So it takes into account how long your credit accounts have been established, the age of the oldest account, the age of your newest account, and the average age of all your accounts. They're taking all of those details into consideration. Maybe how long a specific credit accounts have been established. All of those are taken into consideration as this overall score is calculated. And also the credit mix that you have, the kinds of different creditors that you're paying back, credit cards, retail accounts, installment loans, finance companies, mortgage loans, we talked about the car loan, any of those kinds of things. And then new credit. Research shows that opening several credit accounts in a short period of time represents a greater risk, makes you look like you're desperate going out and getting all the credit cards you can get. And again, I think that's something for students for us to inform them and for them to be wise about, so that they're not just going and thinking, oh great, I can get, you know, a lot of money really quick and go and buy all the brand new tennis shoes or that boutique outfit that the girls may want to have, you know, fairly easily. Because again, as Tom said, our students are being targeted from an identity theft standpoint. They're also being targeted for credit cards. Companies are trying to create those customers early on. So again, I think we need to make sure that we know that the FICO score is calculated based on these 5 categories, but it depends on the individual person and how their their credit is established, their behavior, their amounts they owe, their new credit, all of those things are taken into consideration at the personal level, even though these are just averages.
Now this is an example I borrowed from myfico.com, and if you're not familiar with myfico, great organization to get resources from. Anyway, now credit scores can range anywhere from 200 to 815, and more than 75% of Americans have a score of 695 or greater. Now, consumers with higher scores tend to be a lower risk, and they're less likely to default on their obligation. And they may be and they will be offered more attractive rates. And so in this example, and this is similar to what we saw in the video, but I like this illustration. So if you're reusing this presentation, you've got something right here in hand. So we've got we've got two individuals, one with a 660 credit score, one with a 720. Doesn't seem like that big of a spread. However, when each of them borrowed $20,000 personal loan, the person with 660 credit score, they were charged an interest rate of almost 10.4% versus the person with the 720 credit score, just about 3.25%. And you can see the difference in total overall interest that they paid on that. On borrowing $20,000. So it was around, what is that, about $4,000? So it's significant, even just that small spread between the 660 and the 720. So this is a really nice illustration that helps you kind of lay it out for students. I'm one of those people that's visual and I have to see it. You can tell me all day long and I'll go, I believe you. But once I see it on the screen or on paper, then it becomes more real to me.
Tom, we have a question. Brendan asks, if one is able to raise their score, would a refinance, specifically an auto loan, make sense? And my answer to that is there are so many factors that would, I think, play into that. You would need to know the overall financial situation of this one person. Maybe that would be something that would make sense if the auto loan that they had is a much higher interest rate, and if they've been able to raise their score and can refinance for better terms or something of that sort. I would go into that cautiously. And if I was counseling someone, again, I don't think it's just a really quick answer. It's those of us who've been in financial aid before would say it depends, and I think this would be an it depends. Tom, your thoughts?
Yeah, I think I think it is a big if and depends, because if you refinance, sometimes you refinance it for a longer term. You might be adding, additional interest costs, that sort of thing. Right. Neither April or I are financial planners or anything like that. I think it's something that you need to probably do the math on for yourself. Might benefit you, but also could hurt you. So take a really good look at that.
Exactly. Again, it'd be difficult to counsel someone, as Tom said, and he and Abel, myself included. I'm not a financial planner, but at the same time, I think just common sense is everyone's situation can be very different. So, So next, lowering the score equals greater the risk. The lower the score, the greater the risk for a lender. That makes sense. The lower, as we said about the grades, the higher the grade, the better you've done, if you will. So it gets really interesting. So the purpose of the score is to determine whether or not you'll repay, period. That's it. So this chart actually comes from FICO, the Fair Isaac and Company, and it's the largest credit score producer. So they've put together this chart, and you can kind of see the chance of the default based on the credit score. If your score is between 750 and 799, the chance you'll default is 2%. Right? You can see how low that is. So you may actually get better terms on whatever situation you're trying to get credit for. If your score is below 650, you're most likely going to get a loan that most lenders maybe would not provide. The other thing is when you're applying for student loans, if your credit score is in the lower category, maybe 650 or below, because the federal direct loans don't ask for credit, those students may actually be able to receive a loan they wouldn't get other places simply because their score is low. But I will say that one of the things that student loans can do, if the students are in good standing and repay on time, and there's lots of ways that they can do that now with different repayment plans, could increase that score as time goes on. If you were a lender, When would you consider it too risky to provide a loan? What would be your cutoff point as far as a credit score? What are your thoughts? Type in the chat for me. If you were going to lend someone money and you were going to look at their credit score, what would be your cutoff credit score? Less than 600? So you would cut them off at 600, or you would cut them off at 650, 15% or less. That makes sense. Would you think that also we're back to, would you be looking at the client and the potential of who the client is, and maybe what kind of credit that you're seeing on those credit reports? Would you look at the credit report? You know, those are the kinds of things that we want to do for ourselves or teach our students as well, to look at their credit report and look at that score and see, you know, what is impacting the score one way or the other. So are we sharing credit scores? I'm not sure I understand the question, Andy. Tell me what you mean.
Are we yeah, I'm not sure what that means.
Not sharing your personal credit score. No.
Oh, yeah, yeah.
If you were a lender, what would be your cutoff if you were going to lend money to someone? That was the question. So no, not sharing credit scores. Tom?
Yeah, thanks. I for me, you know, I don't know. I would probably be a little bit more conservative. I'm a little less of a risk taker myself, but let's go ahead and move on. Now, knowing credit reports and how they are graded, you know, what else do lenders look at that demonstrates, you know, credit worthiness? Now, we all know that when you apply for a credit card, typically there's not somebody sitting there looking at your application going, you know, yes or no or whatever. It's all automated. And so if you are declined for a credit card, or if you have been approved for a credit card with a lower limit, you can appeal those types of decisions to an actual person. So when you do things like appeal, lenders are going to look for things like stable employment. Now, if you're a student, you may not have stable employment, so they may ask for, and I know that some of you will find this interesting, a class schedule. Are you going to classes regularly? Your ability to, you know, go to class, or, you know, perform well at school, or have stable employment, it shows some level of consistency that you have the potential to earn income. And so they're more likely to lend to you because you're showing a pattern of good behavior. Lenders might even look at things like they will look at things like your student loans. So if you have student loans and you're paying on them on time, that, you know, your student loans are your first opportunity, real opportunity in many cases, to manage your credit. And so they're going to look at things like that. And that really demonstrates that you're a responsible borrower. You're taking this obligation seriously. It's going to raise your credit score. But again, if it's something, you know, if it's an instance where you're appealing something, they're going to take a look at that and see that you're doing a really good job. So responsible student loan management is key to having a good credit score.
Exactly. And we also know we've touched on some of these, but, you know, there are some credit mistakes. So we need to, again, if we're trying to be proactive and train our folks to know what's going to happen, we need to make them aware of what are some of the credit mistakes. So most people, it seems to be common sense, maxing out credit cards is really just not even the best idea for overall finances. You know, it involves spending a lot of money, and then you're having to pay it all back, and then the cost involved in that. But potential lenders, when they're pulling your credit and trying to look at things, they also care about how much you're charging to your card. You know, as the more you spend, the more likely you'll be able to repay the debt they're trying to give you. So for this reason, there's something called your credit card utilization rate. Very important. So it's calculated by dividing your total credit card balances by your total credit limits. And typically it has a really high impact on that score. So instead, maybe we think proactively about keeping that utilization rate between 1 and 20%. This will show lenders that you're using the credit, but you don't rely on it. It's not the way you pay all of your bills all of the time. So in order to lower your credit utilization, what you need to do is do whatever you can do to keep the balances low. Certainly that involves paying it off, but it also means spending less money on frivolous purchases. You know, the definition of the need versus the want. Cut out those impulse buy. You know, that will help save you money, lower your utilization rate, and help improve your credit. So if you're using your credit cards to pay for purchases that you need and still using up too much of your credit limit, you know, try making payments more than once a month. See if you can do that depending on when you get paid. You can pay for some of those necessities with cash. Try to do some of that. Maybe other budgeting areas, ways that you can do some different budgeting to get that, because you need to make sure that utilization rate is pretty low. Also, making late payments. We touched on this a little bit earlier, but this is so important. Your on-time payment percentage could make or break your score. So they really want to see, lenders want to see when you're a reliable borrower that you repay debts in a timely manner. So consider this Credit Karma analysis. Let me tell you about this. It's while consumers in the, quote, excellent scoring range, 750 or higher, typically pay their bills on time 99.9% of the time, even the average consumer who falls into the fair range, which is 640 to 699, has a respectable 99% on-time repayment record. So that paints a really stark picture. Paying most of your bills on time isn't good enough. Just one or two late payments could have an effect on that score. So we need to keep that in mind. Instead, get those payments in on time as often as you can. If you're forgetful, set up your calendar and make sure that happens. Or if you can afford to do the auto draft, you know, do that, because then they get paid. Maybe you even double up a month and pay some of those. Something like that to make sure those late payments don't happen to impact your score. Also, if you're applying for tons of credit, be careful. Racking up handfuls of hard inquiries. Now, we talked about the hard inquiries. By applying for lots of credit would make you look desperate. We said that before. You need to be very careful. It's frowned upon by those potential lenders. So one or two hard inquiries each year may not affect your score by much at all, but a ton of those can do some significant damage. They seem to think that that would look toward you being very desperate and you just need money, and therefore you may be a higher risk. Instead, limit your applications. Try only applying for one credit that you need, not that you want, that you need. If you're looking for the best auto or home rate, shop around over a period of time. Within 14 to 45 days, applying for the same type of credit line each time during that period between the 14 and 45 days is not going to hurt you like it would if you were just constantly doing that over the entire year. Also, we've already said this, not monitoring your credit, that is important. They need to be monitoring. It's a mistake to not do so. And I think we hit that on pretty hard to pull your credit report, make sure you know what's going on. We need to I know I have to tell my boys sometimes, any kind of email or anything you get from someone you owe, make sure you read it. Don't just put it in the delete it and go on because you think you know who it's from. It may be something very important that you need to pay attention to. Stay on top of those kinds of things. So make sure, again, we talked about don't keep an excessive number of open accounts, just keeping them out there open. Just make sure that you're monitoring everything that's going on. But again, these are the credit mistakes I think that we need to make sure we're upfront and educating our folks on. Tom?
Right. And that we're honest with ourselves.
Absolutely.
Because I've been in a position in the past where I had just so many credit cards open. They didn't have balances on them, but it was tempting. That's another story for another day. But let's talk about some tips on building good credit. We've touched upon some of this already, but I think repetition is key here. Pay those bills on time. That seems like kind of a no-brainer, but it really isn't a no-brainer to many people. They think that, I'll be late this month, it'll be okay by next month or whatever. It can have a cascade effect, but do pay those bills on time. Pay before the due date. As Bridget said, set up automatic payments so it's automatically deducted from your checking account. If you're not comfortable with auto debit, even after we've had it for how many years now and it seems to work successfully, some people just don't like giving access to their credit or their checking account to someone else. Put payment reminders on your calendar and don't put it on the day that the payment is due, because we can't rely on snail mail. We know that most credit card companies and most lenders for other, like your car payment, things like that, they have a grace period, but don't risk it. So put a reminder on your calendar, maybe 5 days, 7 days in advance of when your payment is due. So if you're one of those people who lives off of your calendar like I do, put reminders on there. It's key to pay down those outstanding balances and to keep your ratio down to about 28% or less. I was having dinner with a friend of mine, actually. My friends have these 4 adopted children. The oldest son is now 21. I went into, he was working the other night, he works at Panda Express. He was like, hey, I'm going on break. Why don't you stick around and we'll sit and chat? And so he was telling me about the credit card that he just got through the local credit union, his very first credit card. And he also only has a $300 limit. And so he was telling me that, he charges up on it and then he pays it down. And I'm like, you have that one credit card, but charging it up to its limit is going to look like you're maxing out your credit utilization. So I counseled him on how to manage that wisely and be a little bit being better about it. Do check your credit reports periodically. We can't impress upon you the importance of doing that regularly. It spots things like identity theft, and just, honestly, looking at your credit report sometimes is like shining a mirror in front of your face. Sometimes it's the ugly truth that shocks us into reality that we need, that shock value there. And then dispute errors on your reports. It's so easy anymore. If you find an error on your report, go to the Consumer Credit Reporting Agency's website and dispute the error. Now, just because you dispute something on your credit report doesn't mean they're going to take it off. So if it's a true error, you have every right to dispute that, and they should remove errors. Now, if the creditor, if you dispute something on your credit report, if the creditor doesn't respond within 30 days, then the Consumer Credit Reporting Agency is required to take that item off. But if it truly is your obligation, disputing it does not make it go away. Now, in cases where you disagree with something on your credit report, and the lender comes back and says, no, that's staying on there, you can put a statement on your credit report that others will look at that says, basically, I disagree with this, and here's why. I'm not saying that will necessarily help, but it can explain the situation. But it's important, again, to really monitor your credit to protect your identity. That's the first one of the first lines of defense on spotting whether or not you become a victim of identity theft.
Absolutely, and goes right along with disputing those errors. As Tom said, you can dispute the errors and make sure. And Brandon, I see you personally disputed errors and it worked well. So that's a good process that you can go through, and it makes sure that everything is accurate. Especially, like we said, I think you may find an account listed twice, just duplication, payment histories that are wrong. We mentioned that before. Some that you've never opened. A lot of times those are the kinds of things that happen with people with same names or something of that sort. And again, as Tom said, looking to see about the identity theft and that kind of thing. Here it shows the typical errors: duplicate accounts, inaccurate payment history, information that you have aged off that should be off of there. But I also like this graphic on how this happens. The consumer typically detects an error, initiates a dispute. As Tom mentioned, there's a lot of products out there that can actually monitor your credit. So make sure, if that's something you want to invest in, that may be worth your time and worth your money. Then the National Consumer Reporting Agency requests correction from the reporting source. Then the source, which is usually the lender, verifies and updates the information, and then the consumer receives a credit report. If you do this dispute and you're being told that it's being taken care of, then make sure you go back and check that it actually was done. Make sure you do that. We have some folks typing in the chat. What's the typical time for something to age off?
Now, we have, there's a chart in the presentation. I think that you missed part of it because of technology issues. um, 7 years is typically, you know, the length of time. There are some items that are 10 years, which are things like credit or liens, government liens, tax liens, things like that, and Chapter 7 liquidation, whereas you file bankruptcy and you just wipe it all away. So those are the things that stay on there for 10 years. But 7 years is the standard, and then 2 years for inquiries.
And that's an interesting comment too, Brandon, is that seen accounts you didn't recognize because they had different labeling, if you will, but the bank behind the card was unknown. Again, a way to educate yourself, or to also, if you're giving this presentation, as we said, the train the trainer, that's something to mention, because, you know, your typical new consumer, if you will, may not recognize that. I know my children, I have 4 boys, 20, 22, 24, and 27, and I'd probably have to let them know, hey, make sure that you know the bank that's behind your card. I know sometimes things are sold on the secondary market, that kind of thing. So very good point. Thank you. Tom?
Yep, thank you. Let's see, did this go backwards? It did go backwards. I think Zoom has a mind of its own. Now, there's some obvious reasons that and obvious benefits to having good credit. The first one I like to talk about, you have more choices in and where you're going to live, whether it's a house or an apartment, whether you're going to buy or rent. If you're a recent graduate and all of your friends are finding jobs in the city, they're moving to the trendy neighborhood, and they've all got good credit, but you have less than good credit, and you might end up having to live in a less desirable location. So while they're going out on Saturday night and having a good time and stumbling home from the bar, you might be the teetotaler that evening and driving a little bit farther. So you might be in a less desirable situation as far as housing. Access to banking services. A good example of this is when I moved back here to California back in 2015. I stopped in at the local credit union to open an account, and they actually did pull my credit. They also checked to make sure that I wasn't bouncing checks and things like that. So if you have poor credit, they're less likely to open an account for you, because you might be the type of person, or it might be a higher risk of bouncing checks and causing them to lose money on your account. Better job opportunities. If you are applying for a job that has maybe or if it's in the financial services industry, or maybe it's a job that requires a security clearance or something like that, if you have poor credit, you may be denied that opportunity for that job. Again, fast loan decisions. We talked about that spot financing, where you can go into the dealership and sign on the bottom dotted line, sign on the dotted line and walk out or drive out with the car that day. If you have poor credit, it's going to take the dealership a little bit of time to place you with a lender. So you may have to come back in a day or two if they can find somebody to lend to you. And you also may have to put more of a down payment on, because you could be considered a higher risk. Increased purchasing power. We just mentioned that. A little to no money down on cars. And the most obvious is lower interest rates. The better your score, the better your credit, the better you manage your credit, the more likely you are going to have a lower interest rate. Now, if you have, let me just put this out there, if you're somebody who maybe had less desirable credit at one time, and you got a credit card or something that was a higher interest rate, and let's say you've exhibited good behavior and your credit report or your credit score has improved over time, you can go back to the lender and have them reevaluate your account and take a look and see if you do qualify for a lower interest rate. As a friend of mine likes to say, it doesn't, it's free to ask. Why not give it a try? So just keep that in mind.
Great. So now we're down to, I think we're getting close to the end here. Some of the myths we wanted to mention. Sometimes you think closing a lot of credit cards will improve your credit score. Not necessarily. Not necessarily. Need to be very careful with any kind of I guess, over-the-top behavior. If you're closing, you have 10 credit cards and you close them all, they may not look good. So you need to be strategic in what you choose to to close. That again, that behavior may not look as good as you think it does. Checking the credit report or credit score will reduce your score. No, that's not going to happen. Just checking it will not do that. We talked about the hard inquiries and soft inquiries that may impact that, but this will not. And then your income affects your credit score. No, not income specifically. Now, if your income is lower and you're not making your payments on time and you're not able to pay your debts, you know, maybe indirectly, but not your income related to your credit score, not like that. And then also with a low credit score, you'll never be able to get a loan. Not true either. You may be able to get a loan, you may be able to get a credit card, but those terms and conditions behind that may just be a little less than desirable. So you would need to be very, very careful in receiving a loan under those circumstances. Make sure you read all the fine print, if you will. Also, disputing an account will make it come off of my report. Not necessarily. You can dispute all you want to, but you need to make sure that it's something that's, you know, will come off and that it is in fact an error. So you need to follow that process all the way through. And then lastly, credit scores are locked in for 6 months. How many people know how long credit scores are locked in? Type in the chat.
We know you're out there.
30 days? 1 month? Tom, I'm going to toss to you and let you answer and take it home from here.
Well, that's a good question. Or they're not locked in. My credit score can change from week to week, actually,
Exactly.
because of the way that your creditors report to the credit reporting agencies. Now, they all report on an every 30-day basis, but they don't all report on the same schedule. So mine can change like as often as every couple of weeks. I've seen it happen. So
Right, and keep in mind, there's 3 different companies there as well that's doing that. Agencies that are doing that.
And you know, there is sometimes there's a big gap between your scores with different agencies. Different agencies have different models, different scoring models, and I have noticed that some of my credit card companies don't report to all 3 bureaus, which I find interesting. So another factor or another tip that we did not mention, I don't think we mentioned, but I think it bears mentioning, is that a mistake that you've made on your credit can impact your score immediately. If you're late on a payment, something like that, your score will go down really very quickly. But it takes time for your score to rebound and recover. It goes down, it goes up quickly, but comes back at a much slower pace, or comes back up at a much slower pace. So keep that in mind. I think that's important to note. It just doesn't fix itself overnight.
And it's interesting because I'm sorry, I'm going to interject real quick. And
that's fine.
One of the things that FICO actually says is they're calculated at the moment that it's requested by the lender. So technically, they're updated whenever new information arrives. So really, the answer is the scores can fluctuate and can theoretically change many times during the day, if that's what's happening. So keep that in mind, that you can look at it, and if something changes, it can change by tomorrow. So just keep that in mind.
That's good to know. Now, here are some additional resources if you'd like more information on the topic today. We typically, if we're doing, we do research for these webinars. These we list some of the sites that we went to for some of the information for today. But I would say My FICO is probably one of the best resources out there. They are the biggest and the largest, and they have some great information out there for you. iGrad, who is a partner of ours, they have a credit card simulator where you can go out and take a look at, if you're considering going out and having a good time spending money and you're going to put it on the credit card, this might be a good place for you to stop first to see if it's really a good idea. And then ECMC FAB, Financial Awareness Basics, that's the group that we work for. We have lots of great free resources out there for you. And of course, annualcreditreport.com.
Exactly. Now, we have some really great webinars coming up. Again, we thank you all for joining us today, but we want you to also join us in the future. We've got leveraging social media to promote financial wellness efforts in July. We've got also in July, financial literacy, not just checking the box, peer-to-peer counseling program, a session on that if you're interested in that on your campus. Savings around the world, how do Americans compare? And then in August, we've got 4 more, budgeting and savings when you think you don't have enough money. I'm going to be there for that one as well. FAB Life, we've got some interesting things about our FAB Life. I think you'll be very interested in taking that back to your campus, your financial awareness basics. And then making the most of your financial aid refund. We're bringing this one back. We got a lot of reviews about that one. So making it last. We think that this is a timely one given that it's in the middle to late August when students are coming back. And then 911, financial emergencies that most can't afford. So maybe to talk about, you know, how do you have your emergency fund? Do you need one? When do you need one? So join us for these.
Yep, and just to add on to that financial emergencies, I recently read that most Americans are 1 paycheck away from being homeless, so something to consider. So that one's a very important topic or a timely topic. And then really quickly on the Fab Life game, this is a simulation game that I just did this week for a group of people that you're given a scenario. You might be a mother with 3 children, or you might be a single person who just graduated college and you have a great job, and you need to go through all the stations and find a place to live. You need to buy a car or figure out your transportation, how much you're going to spend. So it's a really eye-opening simulation. So if you're interested in something like that, attend that webinar. We also have a link to it on our website where you can get a copy of the game yourself, where you can actually host events on campus. It comes with all the scenarios and everything that you need to host your own event. So I just wanted to do a plug for that because it's been very popular lately and those game boxes have been flying off the shelf. With that, we're going to wrap things up. We did talk a long time today. Usually it's April and I sucking all of the oxygen out of the room, but today I think it was you and me. Here's our contact information. Please feel free to reach out to us. I had somebody reach out to me earlier this week. In fact, he is on the webinar today. Thank you for reaching out to me, and I hope I answered your questions. We're also on Facebook and Twitter, so we do post regularly financial literacy information that we think that maybe you could use in your own life or share with those who you are counseling. Again, as Bridget said, we will be sending out a copy of this presentation in PDF format a little bit later today. It's just the PowerPoint is just too large to send, so we have to condense it down. If you do need a certificate, please shoot us an email. We'll get that to you also today. So I'd like to thank you all for being with us. We know your time is valuable. We hope we've made good use of that time. And I'm always so happy to co-present with my friend Bridget Ellis. She's not just a coworker, she's somebody I just have a lot of respect for, and she's a great friend. So I'm always glad to present with her. So.
Oh, thanks, Tom. You too. Thank you guys for joining us. We're glad you were here.
All right. Take care, everyone.